Okay, I think we're ready to get started. Thank you all for joining today's webinar. Our tax team will be hosting the webinar on information technology sector and the tax implications for that sector. Just a few housekeeping notes to begin with. If you have any questions during the webinar, please feel free to submit them using the Q&A button at the bottom of your screens, and our tax team will answer them at the end. I'll pass over to our transfer pricing partner, Munjul, who will get us started.
Thank you, Casey. Thanks, John. Hello, everyone. A very good morning to you all. Thank you so much for joining our webinar today. The webinar today, the session today will be around the technology sector, where we'll be discussing various business models or operating models which are prevalent in this sector. And we'll be covering the various tax implications across transfer pricing, corporate tax, personal tax, as well as GST, impacting these business models that we're going to sort of present. With me today, I've got my colleagues Engmin, who specializes in corporate tax. We've got Jeremy, who specializes in GST. And we've got Adrian, who's an expert on employer solutions. Just a quick backdrop to this webinar, and some of the reasons why we are sort of doing this is because, as we all know, the technology sector has become, over the last couple of decades, one of the fastest growing sectors across geographies. This sector impacts all of us in almost every aspect of our daily lives, right from working on software packages at our offices, from ordering food using mobile applications, and from our day-to-day banking transactions using the banking software that are available. Because of such pervasive use of technology in our daily lives, this sector creates a significant investment opportunities for investors across the globe. Not surprisingly, we have observed that a large number of startups are now getting involved in the technology sector, and a huge amount of PE and venture capital investment is flowing within the sector as well. Very often, when we take a look at a particular operating model within the technology sector, we often find that the operating model has been set up keeping in view purely commercial considerations by the promoter or by the corporate, without really getting into the taxation implications for the business or the operating model. However, it's extremely important to sort of take a look and understand and identify the tax implications that could impact your business, that could impact your corporate, that could impact your group, largely because this particular sector has operations across various geographies, and ignoring the tax implications for the company or for the organization could have serious repercussions as the company grows in size, or at a time of exit when the company is going through a due diligence process. With that in mind, what we aim to do today is to discuss typical business models within the sector, within this industry, and then talk through the tax implications that could impact the models that we're discussing. A very quick background about this particular industry is this is a very complex industry and sort of covers a large number of sub-industries as such. What we try to do is have a very quick overview of what this industry comprises of, so that it just gives you a perspective when we actually get into the business models. We have the software and services subsector, which largely comprises of, say, the internet software and services companies, which are largely the Googles and the Amazons of the world, wherein a lot of the services are provided over the internet. You got the IT consulting companies, which help in providing consultancy services, including systems integration, information management, etc., which would probably be your Accenture of the world, your Capgemini of the world. You got purely the IT services companies that either provide ITES or back office services, as well as companies that provide customized software solutions. And you got the software product companies that provide shrink wrap software like the Microsoft, or sort of video game and other sort of applications like the Nintendos of the world. So this is the subsector that relates to the software and services. Apart from this, you've also got the technology, hardware and equipment sector, which provides you with the LAN, the routers, and other equipment such as like the Motorola of the world, the Cisco of the world. And you've got the semiconductor companies which provide the chips as well as the semiconductor equipment. So this is a very broad overview of the sector. And for the purpose of our business models, we're largely going to focus on software and services, because that's where we feel that there are significant implications that could impact most of you all. Yeah. Coming to the typical operating models that we've seen within this industry, we'll start with the most basic model, which is known as the distribution model. The distribution model that we've sort of drawn about here presupposes that the customer base for this particular group lies in the US, and the parent company within this organization is in Singapore. So the Singapore company is basically the principal entity within the group, where all the heads and the brains of the organization lie in Singapore. The various strategic decisions regarding the operations are driven out of Singapore, and the intellectual property for the group is owned in Singapore, which would probably be the brands, which would be the know-how, the wherewithal, and the development expertise as well. To help them with the operations, the Singapore company sets up an Indian group co to do the grunt work vis-a-vis the software development activities. The Indian company operates largely as a captive company and works solely and wholly at the behest and under the instruction of the Singapore company. That apart, the group also has a US group co, which acts as a distributor, because very typically in the US market, the US customers are extremely comfortable, or have a preference rather, to deal with or contract with a US group company rather than a foreign company, largely for liability and other similar issues, which is why the group has also set up a US company which acts as a distributor for the group. From a pure modeling perspective, the way this model works is that the US company will transact with the US customer, and the entire contractual revenues will then be first booked at the US Group Co level. The US Group Co, being largely a liaison company which does more of marketing and support work for the Singapore company, will, from these revenues so received, retain an appropriate amount of revenues that would just cover its operational costs, plus a routine cost plus base margin, and the balance revenues emanating from the customer contract would be swept back to the Singapore company through a sort of a service invoice raised by the Singapore company on the US Group Co. The Singapore company on its part would then compensate the Indian company on a cost plus basis for the captive services of software development provided by the Indian Group Co. In this case, the entire impact would be that the US company and the Indian company would work as sort of service providers or distributors for the Singapore Co, and would retain a routine profits on a year-on-year basis. The Singapore company, being the entrepreneur, being the IP owner, and being the sort of business driver for this entire group, would have the entrepreneur profits, which could either be a super profit or could even be a loss, depending on the relative success of the business for a particular year. So this is typically known as a distribution model, and companies operating under such model need to sort of take care of certain transfer pricing, tax, and GST issues as well. What are the issues that could impact this particular business model? One is the substance issue. As we move from a substance over form regime now with the BEPS coming into place, with anti-avoidance coming into place, it's extremely important not only to have substance, but also to demonstrate it through transactional document as well as from your transfer pricing statutory documentation that has to be maintained annually. From a Singapore company perspective, it is imperative that the Singapore company maintains sufficient documentation to sort of showcase that they have the ability and the wherewithal to take the entrepreneurial decisions that they're taking, which entitles them to the super profits for the group. From an Indian company perspective, it needs to demonstrate that it is indeed a contract developer as against a full-fledged developer, because it's extremely important to show that the services that they're providing are at the behest and under instructions from the Singapore entity, and the Indian company is not in a position to take entrepreneurial decisions themselves. From a US company perspective, they need to sort of showcase whether they're a marketeer or a full-fledged distributor, because the returns would largely depend upon how it characterizes itself. Extremely important to have very well drafted agreements in place between the various group entities to sort of showcase the roles, responsibilities, and the risk matrix of these entities, such that it becomes quite evident to tax authorities around the world what each entity does within this structure. Also, extremely important to monitor the activities on an ongoing basis, because as we all know, business is never static. It keeps sort of evolving over a period of time. And it's extremely important to sort of keep monitoring this to ensure whether the characterization that was true a year or so back is still appropriately documented even today. Largely, we've seen a huge amount of litigation in this space in various countries because of the characterization issues, because of the margins issues, etc. So very often, if the volumes of the transaction are huge, or if there seems to be some sort of dispute going on, may make sense to sort of get a proactive resolution to disputes by going through an APA. So these were just some of the transfer pricing matters that we thought that could impact this particular model based on our experience. I'll hand it over to Engmin to take us through some of the corporate tax issues that one should take care of while operating under this model.
Thank you, Munjal. Casey, you have to start my video because you are the one who actually blocked it. I can't. Right. Let me just continue with the corporate tax implications. Now, okay, sorry. Right. Okay, I'm here. So the first thing that we need to ask ourselves is that in this model, there will be a payment by the Singapore company to India. So what is the nature of this payment? Would it be considered a royalty type or a license fee payment? Or would it be considered a service cost that is actually paid by Singapore to India? So that would help us understand whether there is a withholding tax on that payment by the Singapore company to the Indian group co here. And if there is a withholding tax, then there's always the additional cost of this particular model that we need to look at. And then on the other side of it, we have US group co selling to the customer directly, receiving the revenue, and then on paying some of these, which we, in this case, wanted Singapore to be the entrepreneur. So therefore, you know, the large chunk of profits would really be in Singapore. So question now is, when US group co make that payment to Singapore, how do you characterize that payment? Is it something that's subject to withholding tax in US? And if it is subject to withholding tax in US, would it be creditable in Singapore? Now, if it is not creditable in Singapore, then you have an issue of a double taxation in the model, right? So now the next point I would like to look at is that in terms of the effective tax rate, if you look at the group, we have got US, we have got Singapore, and we have got India. And clearly we all know that Singapore has got the lowest corporate tax rate as compared to US or India. So then we go back to what Munjal has said just now. What sort of substance do we have in the Singapore company for it to be, you know, having a larger chunk of that residual profits so that the group as a whole would have a lower effective tax rate. Okay, so now let me just move to Singapore now. If I look at Singapore, I would basically, Singapore being an entrepreneur here, then the question is, should the Singapore company apply for some form of tax incentive that would help bring the tax rate down to say a 5% or a 10%? Is it something that, you know, it's worth the Singapore company considering? And you know how the tax incentive regime is actually run in Singapore. And if you do intend to apply for any of these tax incentive, you have to start early. You have to talk to the various agency before you actually start work in Singapore, because the main drive is actually to incentivize and bring businesses to Singapore. So if you've done something already, you may not be able to get it. Okay, quite apart from the tax incentive, there are other things in Singapore that potentially the Singapore company can look at. Can you do more R&D activities in Singapore? We have a very generous enhanced R&D claim regime. For R&D that's conducted in Singapore, for every dollar of R&D expense that you incur, you get another $1.50 of deduction. So that may be something attractive, and that would help, you know, bring down the overall effective tax rate if the bulk of the residual profits will be parked here in Singapore. And then of course the last one is that whether the Singapore company will pay for any IP, and if there is an IP payment, then potentially we could also claim writing down allowance. It's a straight line claim, 5 years, 10 years, or 15 years. So if you see that in the initial year, the company will not be profitable, you may want to like spread out the claim over that, over a period of 10, 15 years, whatever, depending on the projection of the company. Because if not, if you have claimed it and you carry forward, there are certain conditions that you need to meet before you can continue to carry forward those claims. Now, I will now pass it over to Jeremy to talk to you about the indirect tax implications.
Thank you, Eng-Ming, and good morning, everyone. As some of you may be aware, whilst the indirect tax implications are not always considered a crucial factor within the commercial decisions around the structuring, the potential implications of getting it incorrect from an indirect tax perspective can actually make or break a supply chain. To begin with, the potential implications could range from a mere increase in compliance and administration costs, but at the other end of the spectrum, you could actually be creating an irrecoverable GST or VAT cost within the supply chain, therefore reducing the overall group profits on the activities. And in order to try and mitigate that, the way we approach it when we look at a structuring project, we first have to begin with, we need to identify each of the transactions within a given structure. So in the example here, there are 3 specific transactions that we would need to consider, both from a US, a Singapore, and an Indian tax perspective. And once we've identified those transactions, there are a number of considerations that we need to undertake for each of those transactions, and that could be first beginning with, well, what is actually been supplied for that transaction in the first place? From a GST perspective, are we talking about a supply of goods, a supply of services, or even nowadays a supply of digital services, which are actually taxed slightly different to a supply of services? And then much to Mahendra's point earlier, what documentation or service agreements have we got in place which clearly show who the contractual parties are within the supply chain? Does the actual flow of services, do they match the service agreements? And actually, how much are these companies paying for the services? Is that documented within the service agreements, and is that in accordance with the transfer pricing policy to begin with? And once we've got those fundamental points identified to begin with. That is when we can determine from a VAT or GST perspective whether the supply between, say, for example, the Singapore Co and the US Co can qualify for zero rating as an international service, or whether that is still actually liable to GST at 7%. And if that were to be the case, then that is the situation where we have an irrecoverable GST cost within the supply chain. So we need to look at the GST or VAT treatment both from the supplier's perspective, and also now, since the 1st of January 2020, from a Singapore perspective, we also need to consider the GST implications where the Singapore company is the recipient of the services from the Indian company, as to whether those suppliers are also now caught by the reverse charge as well. Once we've identified those, and then in terms of the implementation, well, once you have implemented the structure, we then need to think about, well, actually, at what point is a GST or a VAT liability even triggered in the first place? Within the supply chain, is it triggered by the issuance of a tax invoice? Or if you're not issuing the invoices because it's all within the same corporate group, would it be made on the date of the payment? But again, if there are no physical payments being made between the group and they are just book entries, then whether the transactions are caught by the deemed anti-avoidance time of supply, whether they're caught by the deemed anti-avoidance time of supply rules, and these will also be different from jurisdiction to jurisdiction. So we would need to consider those indirect tax implications on that jurisdiction by jurisdiction. On that point, I'm going to hand back over to Munjal, who's going to take us through the next common model that we tend to see within this sector.
Thanks, Jeremy. Thanks so much. Yeah. So a natural sort of progression from the first model over a period of time is when some of the groups move from model 1 to model 2, which is then known as the licensing model. In this model, the Singapore company, which typically used to work as an entrepreneur at the onset when the sort of operations first took off, starts sort of giving up some of its entrepreneurial function and is then sort of restricted to sort of just owning the base IP or the base sort of software license in the product. In this model, you probably have the Singapore company which owns the base IP, which it continues to sort of own and continue to maintain with the help of the Indian group code that continues to provide the captive service to the Singapore company. What the Singapore company gives away to the US group company within this structure is the entrepreneurial functions relating to the entire marketing, the selling, and customization of the product to the customer needs in the US. Since the customers are largely in the US, and since the US group company is best suited to sort of start owning and developing the customer relationships, that moves from Singapore company to the US group co as well. What the US group co also does is it continues to sort of liaise with the customers on a regular basis and uses the base software to develop new products, new solutions, add-on features, etc. And hence a large part of the IP as well, apart from the customer relationship, starts shifting from the Singapore company to the US group company in this case. In this structure, then the US company then becomes the entrepreneur. You have Singapore company, which then sort of partakes the characteristic of the owner of the base license or the base software, and the Indian company continues to provide captive services. Initially, in Model 1, it provided these captive services only to the Singapore company. However, in this licensing model, it may also provide these services to the US company who, by doing the grunt work for the entire add-on developments, for the customization, etc., which is largely driven by the US Group Co. In this model, the revenue flow as follows. You got the US customer who transacts with the US Group Co in this model. And as usual, as we saw in the model 1, the entire contractual revenues will first be booked at the US Co level. In this case, the US Co is responsible for developing the final solution, is responsible for customizing the software to the customer needs, and hence all they transact with is with the Singapore company. The transaction with the Singapore company is then restricted to just licensing the base software, and as a consideration, they pay a fixed or a variable royalty to the Singapore company for the use or for the exploitation of the base software, as against parting with the residual profits as they did in Model 1. Further, the US company also compensates the Indian Group Co for the development work or the contractual software development work that is done for the customization that's required by the US Group Co. The Singapore company continues to earn the royalties from the US Group company in this model, and from a cost perspective will also pay the Indian Group Co for the development of the software or the base software and its maintenance on an ongoing basis. So again, from a revenue perspective, you've got the US Co now operating as the entrepreneur and owning the entrepreneurial revenues, which could be super profits or super losses. Singapore company will earn a significant royalty for the licensing of the base software to the US Group Co, and the Indian company continues to earn captively earn service fees from the US Group Co and the Singapore Co for developing the software and maintaining it at the behest of the Singapore Co and the US Co. From a transfer pricing perspective, again, coming to the substance issues, very imperative for the Singapore company to sort of continue to demonstrate that they own and are the economic owners of the base software, and all decisions relating to owning and maintaining this software is taken by the Singapore company. The US Group Co now has to demonstrate that they are the ones who own the customer relationships and take all significant decisions relating to customization of the software to ensure that they are deserving of the entrepreneurial revenues from this model. And the Indian company has to continue to demonstrate that they operate as contract software developers and do not become full-fledged developers as such, because the decision-making still does not lie with the Indian Group Co. As we mentioned earlier, you've got to keep monitoring the activities to ensure that the business realities are aligned and are in sync with the business operations and the transfer pricing policies of the group. And once again, we've got to ensure that the agreements are now sort of tweaked to showcase the new relationships between the various group companies. Handing it over back to Engmin to talk us through the corporate tax implications.
Thank you, Munjal. Okay, in this second model, we're actually looking like a licensing model. So the Singapore company would be paid some form of fees by the US Group Co for whatever that, whatever knowledge or whatever methods that they have. And then there are two other payments, which is from Singapore Co to the Indian Group Co, as well as US Group Co to the Indian Co. So similarly, what we need to examine is the characterization of these payments. Are they considered some form of license fee or software payment? If so, then what sort of withholding tax rate would be applicable on those payments? And Singapore paying India, similarly, we look at our rules to see whether there's a withholding tax on it, because all these withholding tax will add on to the cost of doing business, will affect the group effective tax rate, especially if these withholding tax rate if they are not creditable in the end, right? So in this case, I think US become more prominent in this particular model. US become more prominent, and then because US has got a higher tax rate, so in the overall management of the effective tax rate of the group, if you want more profit drop in Singapore, then depending on what you can do in terms of your transfer pricing studies as to how much more you can actually drop in Singapore, depends on the functions and the roles that are performed by the Singapore company as to whether the reward will commensurate with it or not. And also, although US now is more prominent in this overall structure, Singapore is still doing something. They own the royalties. So then the question is, are the activities in Singapore substantive enough? Do you still want to consider applying for tax incentive? And what sort of R&D would actually be done in Singapore, or would you want to put more R&D activities in Singapore to benefit from that enhanced deduction, the extra $1.50 or 150% deduction that I mentioned earlier on? And then we also have the issue of Singapore claiming the writing down allowance if it's possible, if you want. And then of course, the more important thing that would affect the overall tax rate is that if there is any withholding tax that's Singapore suffer from when USCO make a payment to Singapore, Singco, can they claim? You know, would there be a risk of a double taxation here? So these are all the issues that we need to look at when we evaluate this model. And now I'll pass it over to Jeremy to talk to you about indirect tax implications.
Right, so yeah, as I mentioned during the Model 1 section, the first port of call for us from an indirect tax perspective would be to identify each of the specific transactions within the proposed structure, and then to ascertain sort of the nature of the supplies. So if we begin with the US Group Co, they are making a sale of or a supply of services to a US-based consumer. So the US Group Co would ultimately need to consider their state and local taxes obligation in the US to begin with. And then when we drop down to the Singapore Co, again, we have a supply of services between the Singapore and the US Group Co. So to begin with, the Singapore Co would need to consider, well, what is the nature of the services that I am providing to the US Co? Do they qualify for zero rating as an international service? And then the US Group Co would need to consider whether there's any indirect tax considerations for the import of the services from the Singapore perspective. The Singapore Group Co would also need to consider the reverse charge position on those captive services received from the Indian Group Co. And then if we were to look at the Indian Group Co, they have now actually got two transactions. They're making a supply of services both to the Singapore company and also now additionally to the US Group Co. So they would need to analyze both of those transactions to ensure whether they could zero rate those as international services from India. And if they were not able to substantiate that point, then they would actually have to charge local tax on those supplies, and that is where we would have the irrecoverable indirect tax cost being built into the supply chain. And again, to Mahendra's point, this is where we would also need to make sure that the documentation, that the service agreements clearly shows the contractual party, the flow of the services, the nature of the services, and ultimately the value of those services to back up the conclusions that we have made and the tax treatments around those specific transactions, should the tax authorities from the relevant jurisdictions raise any questions in relation to those. So on that point, I will pass back over to Manjal to move on to the next model.
Thank you, Adrian. Thank you, Jeremy. Yeah, this model, this is model number 3, which is typically known as the direct licensing model. And this is a sort of a flip from the first model that we had talked through earlier. And this model presupposes the US Group Co owning the intellectual property and the entire sort of commercial rights within the organization, and has a significant client base in Singapore. So it's just a direct flip from what we saw earlier. And in this case, the US Group Co tends to transact directly with the customers in Singapore by licensing its software products and software solutions to the Singapore customer. That said, the US Group Co does set up a Singapore subsidiary in Singapore to assist with the local support, with a bit of marketing, with a bit of liaison with the customers to ensure that the customers are well taken care of and any sort of needs are being met. The US Group Co continues to have an Indian subsidiary who provides certain captive software development services to the US Group Co in this model. The pricing arrangement in this case would be as follows. You'd have the Singapore customer directly paying contractual revenues to the US Group Co for the use of the product or for the solutions. As against this, the US Group Co would compensate the Singapore Co by either a marketing or a local support fee, depending upon the intensity and the nature of the activities performed by the Singapore company. The US Group Co would also pay the Indian subsidiary a service fee for the contract software development assistance provided by the Indian company to the US Group Co. What are the transfer pricing implications that one needs to be careful of? The first one is the compensation to the Singapore entity. Very often, a lot of groups tend to sort of put a very simplistic cost plus 5% fee to the Singapore company in this case, because I mean that's something that's prevalent in the safe harbor regulations in Singapore. However, I mean, it's extremely imperative to ensure the intensity and the nature of functions that are provided by the Singapore marketer or the support service provider. And very often, if the Singapore company is doing a lot more than just the liaison role and is playing an active role in the marketing, soliciting the customers, as well as owning the customer relationship as well, one may actually have to compensate the Singapore company by way of a commission or a percentage of sales or any other alternative pricing approach as well. So extremely important to identify and review the roles and responsibilities of the Singapore entity to ensure whether the compensation structure is appropriate or not. Similarly, the US Co has to sort of demonstrate that it is indeed a contract developer and not a full-fledged developer, and a large part of the decision making and the ownership of the programs and the IP and the knowledge is indeed with the US Co within this structure. Again, as we mentioned earlier, keep monitoring the activities of the group just to ensure that what you documented continues to exist as time goes by, and have extremely robust agreements to ensure that the roles and responsibilities of the various entities are well spelled out and documented, such that it becomes pretty easy to justify this during your transfer pricing audits. Moving on to the corporate tax implications, I hand it over to Engmin.
Yes, in this model, what the US Group Co will be doing is that they will be selling directly to Singapore-based customer. So the first question that we need to address is, when the Singapore customer make a payment to the US Co, is there a withholding tax on it? What is the character of this payment? And if there is a withholding tax, is it creditable back in US? And what's the impact on the overall effective tax rate in US? And here, US Co would also be making payment to Singapore for that local support services that will be provided by Singapore Co. So again, I mean, we ask questions of whether there is any tax that will be suffered in terms of withholding tax and whether it's creditable back home in Singapore. Similarly, for that payment to that Indian group company, whether there is like a withholding tax on it. So in this structure, Singapore is relatively light. it's basically US and then India providing some service and Singapore providing some services. So the question of how you can actually manage the effective tax rate of the company will come in again. And as to, you know, whether what sort of support services that Singapore is providing and how much, you know, they ought to have been compensated for it. So, and here for Singapore, the only issue that I could see is in terms of whether the withholding tax is creditable or not for the Singapore company in terms of the services that have been provided by it to the US Group Co, to the customers here in Singapore. I'll now pass it over to Jeremy to talk about the indirect tax implications.
Thank you, Amy. As Manjot mentioned, this is a very common structure that we have seen, and it is one that has been increasingly targeted by BEPS, specifically from an indirect tax perspective since about 2015. The key reason, if we look at the transactions in place, although we now have the US Group Co contracting directly with the customer in Singapore, and that brings across a number of indirect tax considerations. The first one being is, are we talking about a standard supply of services, or in this specific case, are we talking about a supply of digital services? I'm sure you've all heard of the Netflix tax. So in terms of on the 1st of January 2020, Singapore implemented the overseas vendor registration regime, which is specifically targeting groups that have this structure whereby the US Group Co is actually directly contracting with the Singapore consumers. Historically, the US Group Co would not have had a liability to account and charge Singapore GST on those transactions. However, with the introduction of this new regime, we need to consider whether that US Group Co now actually has a liability to register for GST in Singapore, thereby obviously reducing the effective gross margins that it is receiving from the Singapore consumers. So we need to consider whether those Singapore customers are business customers or whether they are actually individual consumers in the first place. The second key risk within this specific structure is on the local support service provided by the Singapore companies, and whether that Singapore company can actually zero rate the support service to the US Co. The zero rating provisions in Singapore are more restrictive than a number of other jurisdictions, in the sense they also have a direct beneficiary test. So we need to consider whether the direct beneficiary of the Singapore Co service is a Singapore customer, or whether it is purely the US Group Co that is benefiting from that service, and thus the supply can be zero rated. So on that point, I'm going to hand it back over to Manjot to go through, I believe, the last model that we have.
Thanks, Jeremy. Thanks so much. Yeah. The last model is typically known as the hybrid model, and I've typically seen this model often used in software product companies. And what this model presupposes is, as against the other models, you got both the group entities in the structure operating as entrepreneurs. So if you notice in the earlier models we sort of spoke through, you had one entrepreneur within the group, and the other companies within that group operated either as service providers or IP owners, etc. But in this structure, you have, say, the Singapore company who owns what is known as the technology or the know-how within the group, and you got the US company which owns the marketing intangibles within the group. What the US company does in this particular structure is develops the brands and marketing intangibles for this product. It owns the customer relationship, which in this industry is an extremely important intellectual property or an intangible asset, and incurs huge amount of advertising and marketing costs for popularizing the products, the software products within the US market. As against that, you've got the Singapore company that continues to conduct huge amount of R&D to develop and conceptualize products and services. It creates the shrink wrap product, which then sort of can be sold to the US and enters into a buy-sell transaction with the US company for selling its product to the US company. They're selling the shrink wrap software products to the US Group Co, who then sells it to the final customer. Now, neither of the approaches that we've seen in the earlier models, whether it's a cost plus or a licensing approach, can be used in this because they both are entrepreneurs, and neither of the group entities, that is the US Group Co or the Singapore company, will be happy or will be sort of content with a routine return, and both would really want their share in the pie of the profits. So typically, we've seen what is known as a residual profit split approach adopted to split the transactional profits from the operations between the US Group Co and the Singapore Group Co, so that they get a fair share in the pie of the organizational profits, commensurate to their relative contributions to the operations. We've just sort of shown a very simple simulation model out here to show how the profits or the transactional profits would be split between the US Co and the Singapore company, wherein from the consolidated profits of the group, which in this example is $2,000 from a sale of $5,000 and a consolidated cost of $3,000 incurred by the group entities, the $2,000 is then split between the US company and the Singapore company, first by providing each entity a routine return for the routine operations of selling and software development activities, and the residual of $1,600 that is remaining after distributing the routine margins are then split in the ratio of their relative contribution to this operation. This is probably the most appropriate manner to ensure that each entity within the group gets a fair share and an appropriate share of the group's profits commensurate to their relative value add. Leave it to Engmin to cover the corporate tax implications within this.
Yeah, in this model, we have got both US and Singapore participating actively in the supply chain. So then in terms of the effective tax rate, that's the part where you can basically manage it as to how, you know, you can actually bring it down to a level that the group would require, would want. So back to the characterization of payment here, we have US making a payment to Singapore, and then we have actually used the transfer pricing method that we talk about, residual profit split and so on. But the key questions for corporate tax is that what is that nature of the payment that is being paid? How do we characterize it? Is it for some form of a royalties or some form of a license payment? Is there a withholding tax? And here, because Singapore would be more active in the participation of, in the whole overall supply chain, we would also ask the question of whether they should be applying for some form of a tax incentive, you know, whether the activities in Singapore that will be undertaken will be substantial enough for them to consider making an application for it. And in terms of that technologies that will be created in Singapore, would it qualify for R&D claim? Can they claim enhanced R&D for that? And would there be any like an IP payments for which they can claim writing down allowance? So these are all the questions that we will need to evaluate when we look at this model. And of course, the one that I have been repeating, if there has been a tax suffered in terms of a withholding tax, can you claim it back in the form of foreign tax credit? And if not, then what does that mean to the overall effective tax rate of the group in this whole model? Right. With this, I will pass over to Jeremy to conclude on the indirect tax part.
Thank you, Engmin. So as we can see, the actual fundamental contractual parties here are very similar to the other models that we discussed under Model 1 and Model 2. But again, from an indirect tax perspective, we would need to look at the contractual parties and the flow of services, but we would also, given the nature and the roles of the companies are slightly different under this model, we would need to consider whether that change in role actually affects the nature of the service that each of them are providing to each other. So again, we would need to consider the GST liability of the service being provided by the Singapore Co to the US Co, and then ultimately the nature of the supply between the US Group Co and the US customer, and the potential state and local tax implications of those as well. So again, sort of just to summarize, within this we would also need to consider how is the GST or the state and local tax actually triggered in the first place. Is it due to the issuance of a tax invoice, or is it due to the payment in respect of the suppliers in respect of the supply of services, or whether again, if those two are not present within the supply chain because everything is just booked through the intercompany as no official tax invoices or payments are received, whether the deemed time of supply kicks in, and how that and how that is captured from a GST, a VAT, and a state and local tax reporting perspective. And sort of just to summarize again, to make sure that all the service agreements clearly reflect the nature of what is actually going on within practice. And to that effect, I'm going to pass back over to Manjal to summarize as well.
Yeah, we just got the entire GMS implications on the model with Adrian coming in.
Hi everyone, I hope you're still with me, and thanks to all my co-presenters so far. We're going to cover something slightly different now. We're going to cover people effectively. And I know technology is replacing people in many cases, but people is still an important part of many tech firms. Within the Employee Solutions team, which I lead, there's basically deals with anything to do with your employees. And as we deal with employees, it's usually the employer-employee interactions and relationships that matter rather than necessarily the corporate structure. But the corporate structure does still have an impact, and your expats do have knock-on effects from a transfer pricing, GST, and corporate tax perspective. So in the next 5 to 7 minutes, I'm going to try to cover off or give you a highlight in some of the areas that I typically see as misunderstood from an employer solutions perspective, in 3 main areas. One is global mobility, one is employment taxes, which is linked to global mobility, and the last one is equity reward. And just a note, from the equity side, our next webinar is actually on equity, and it will go through some of the stories and some of the misconceptions of equity, and that is on Wednesday, the 5th of August, so feel free to register that separately. As a backdrop, I guess, we've already mentioned a lot of times that data is really important, and having documentation is really important. And, with tax authorities having much more information at their hands, they're using that a lot more intelligently. And so companies need to make sure that they've got sufficient documentation data to support the positions that they've taken and the withholding that they've taken. And now to go on to the global mobility side. From a global mobility side, we're not just talking about your typical expats. You might have a short-term expat for 3 months all the way to long-term and permanent transfers. But what we're talking about is also your remote workers. So people who work from a different country from where they're employed, your commuters and your business travelers, which is one of the biggest risk areas for global mobility and employers globally. So do you know where your business travelers are at any one point? And do you know what your withholding reporting requirements are for those individuals? And do you have the documentation to support this? And then I guess finally, a lot of the things I see in Asia is we see a lot of regional roles, especially from Singapore. people who are employed from a Singapore entity and, may cover the whole of the APAC area. In the general section on the slide, I've outlined some of the areas to consider when you're dealing with employees, and I'll go through some of the misconceptions for each of these points. But before I start with that, when you deal with expats, a lot of the time, even with tech firms, we find that when you're sending your first couple of expats over, a lot of the time you negotiate the salary and benefits related to that assignee on a case-by-case basis. And some assignees are better at their negotiation than others. And a lot of assignees and expats, and we've got a couple who are presenting today, a lot of expats generally are a lot more open to sharing, what benefits they get than local employees. And so there can be a lot of confusion amongst expats in terms of whether they've got the best package, whether someone else has got a better package than they have. So we work a lot with employers to make sure that, you've got appropriate policies in place, so there's consistency across the board, and you can provide clear communication both internally within your business groups and also with the expats, so they know exactly what they have. And attached to that, when the employer wants to pay some of the taxes, then it's important to have a robust tax protection or tax equalization policy in place, so there's no disputes or misunderstandings when those arise. So going through the general points on this page, where are your employees tax residents? This is tax residents. This is not immigration residents, and the rules are different for each country, and can be based on the specific country. So individuals can actually be resident in more than one country, and vice versa. They can actually be nomads, as in not tax resident in any particular country. Doesn't mean they're not taxed anywhere. They're just not tax resident in any country. And once you've established where your employees are resident, and once you've established where they're working, then you need to establish what your employer your tax, social security withholding obligations are, and what reporting obligations you also have. Often with cross-border employees, you'll have multiple countries involved and therefore multiple reporting obligations. And one of the misconceptions we see here is he's in that country for less than 183 days. We don't have to do anything. 183 days is an important test, but it's not the only test. So if we take the US Singapore, for example, as we looked at all those 4 models, if you've got employees from the Singapore entity working in the US entity for any length of time, there is no tax treaty between US and Singapore to protect you. You have to follow the US domestic rules. And there is a chance that one day in the US technically triggers filing obligations for the employer and the employee. So it's worth understanding what the actual rules for each country are that your employees go to work, and obviously take a risk-based approach in terms of how compliant you want to be in those countries. Obviously, in an ideal world, you'd be 100% compliant, but we know that that's not necessarily possible in all situations. And then I'll move on to remote workers as the next one, because that's tied in with the business commuters as well, or some of the issues are tied in there. With what's going on with the pandemic, we've seen the biggest working from home experiment potentially of our lifetimes. And for a lot of people, they've quite enjoyed working from home. But what we've noticed is actually, if you look at tech firms, they've been slightly ahead of the curve in this respect. A lot of tech firms that I've worked with already have people who don't work from the country they're employed from. So your Singapore entity, for instance, may be employing people who live in Bali or the Maldives, for example. And if you have those, because you're seeking out the best global talent, you do have to realize that tax is a little bit more archaic than technology. And so we need to understand whether your remote workers in those other countries, like if you've got business travelers to those countries, are they creating a corporate tax risk for you by way of a permanent establishment? And if there is that permanent establishment risk, do you already have an entity there which you can second the individual to potentially protect your P risk in those countries? So there's a lot of things to consider when you've got those remote workers. And And there's transfer pricing considerations if you've got that PE, and potential GST implications if you've got those PE risks. So a lot of clients come to me and say, okay, we've got these remote workers. One's if I just make them a consultant instead of having them as an employee. That's an easy way out of it. They're a consultant, I don't have to worry about them, I just pay them a consultancy fee. Again, a lot of countries have rules in place to really determine whether the relationship between an organization and an individual really is an employer-employee relationship, or whether it's more akin to a self-employed consultancy status. And even if it is a true consultancy status, my colleague Eng Min will probably be jumping up and down saying there are still cases where consultants can trigger permanent establishment risks. So it's important, if you've got consultants, both in your current country and in other countries, to make sure that you're truly comfortable that they're consultants, and secondly, whether they are triggering other tax implications as a result of those. And finally, I wanted to touch on equity awards. Many tech firms that we work with, and globally obviously, have implemented equity schemes. It's a nice way for companies to give ownership in the company to employees, to incentivize them, maybe lock them into the company for a number of years. Or if you don't have cash to start off with, or you want to save your cash for other things, you can give them remuneration through equity, which is cheaper, I guess, than paying them up front. I guess one of the misnomers here is, what have you actually given them? There are many different equity types globally. So you may have options, you may have restricted stock units, restricted shares, growth shares, phantom plans, stock appreciation rights. And all of them may sound very similar and may ultimately give similar economic value to those individuals, but different countries may tax those differently. And even within, let's say, one of those plans, an option plan, 2 different stock option plans can also give you different tax implications. So it's important for an employer, when you're trying to roll out one of these plans, or when you're trying to administer one of these plans, that you truly understand what the employer obligation is in each country. Do you have to report? Do you have to withhold? What happens if you don't withhold? Does that mean the employer is on the hook for the taxes that is due? And then once you understand the obligations in each of those countries, communication with expats and just employees are key. I know many employees who come to me and says, I've got these options, but they're not from Singapore. I'm employed here, they're on a US headco. That means I'm not taxed right. But usually it doesn't matter where the equities are based or where the underlying shares are based. If it relates to your employment, they're generally taxed as employment income. So having that clear communication with employees is important, because obviously when these equity become taxable, usually there's no cash involved, they've just got shares. So the employee may need to find a way of funding any tax liability through the sale of shares, for instance, or through their own personal reserves. So I appreciate that's a really high level overview on some of the employer solution issues that results as a result of tech firms. But as with employees, if you get something wrong, a lot of times it multiplies pretty quickly because of the number of employees that you have, and also the fact that it may stray into GST, corporate tax, etc. And with that, I'm going to hand back to Manjul, I believe.
Hey, thanks, Adrian. That was fantastic. Yeah, so after going through all the models, we've sort of gone through 4 different models. We've heard about the various implications under the various regulations and regimes. Just thought we'll just sort of have a very quick 1-minute summary, just so that, like, the key takeaway points. 1, the operating models cannot be driven by tax. They're always driven by business and commercial objectives. However, it's extremely important to ensure that whatever business models that we develop based on our commercial objectives, they are aligned with the sort of tax treatment and the transfer pricing aspects as well. Have in place extremely robust service agreements and IP agreements to ensure that our sort of business model is well sort of covered in the service agreements and the various commercial arrangements that we have, to ensure that we're well protected when we go to a tax or a transfer audit. And do review your models on a regular basis, because business is never static, it's dynamic. And to ensure that the pricing model and the sort of tax implications are aligned with the business, and we've not sort of like, ignored the entire changes to our operations over a period of time. That's in gist, and we're ready to sort of take questions, handing it over to Casey now.
Thank you, Munjal. I'm conscious that we've run a little over. Thank you to everyone who has submitted questions. And what we can do, just because we're running about 10 minutes over, what we'll do is we'll answer those questions directly to those who have submitted them. And if you have any further questions, please feel free to contact a member of our team. As Adrian said, our next webinar will be on the 5th of August, and we hope that you can join us. Thank you very much, everyone who's joined us this morning, and to our speakers. Thank you.